The whole secret of achieving great success in the stock market is not always true, but at least you can lose some money when you will get wrong with your principles and strategies. There are many things that people ignore while investing in the company. The book How to Make Money in Stocks by William J. O'Neill has explained the CAN-SLIM strategy very well. CAN-SLIM strategy, which you can use to make less losses and more profits in the stock market. Before that, I want you to subscribe this channel so that you can watch the video related to finance, investing and stock market, and you can achieve financial freedom, which is our goal. So let's begin the video. This strategy is divided into 7 sections. Number 1, current quarterly earning per share. The company's stock you have chosen to buy have the earning per share of that company should increases by more than 20% in the comparison of last year's quarter. If you are new or an experienced investor, then also you should not invest in such stocks whose earning to share ratio is less than 20% as compared to the same quarter of last year. Many successful investors keep this parameter at 25 to 30%. For an example, there is a company XYZ Limited whose earning per share was 50 in third quarter of last year and 60 in third quarter of this year. Here we see an increment of 20%. This indicates that the company's current quarterly earning per share is increases. Number 2, annual earning increases. The company's stock you have chosen to buy, the share of that company on annual earning should keep increasing from last 5 years. Select such stock whose annual earning growth rate is increasing by 25 to 30% since last 5 years. For an example, there is a company XYZ Limited whose share price was 100 rupees in 2015. If there is growth of 50% year on year, then according to the compounding principle, its share price will increase to 150 in 2016 and 215 in 2017 and 322 in 2018 and 484 in 2019 and 725 in 2020. If we invest in such company, then we can get more than 700% return in 5 years. Number 3, new product, new management or new events. The company is doing something new to increase the value of the stocks, like any innovative product that beat the competitors and create a new market. Either the new CEO of the company who changes the organizational behavior or brings some new changes like bringing new technology or supply shortage. Number 4, supply and demand. Everything in the world runs on supply and demand, and this law also applies in the stock market. For an example, let's say a car auction is going on and you like that car. When you reach there, you come to know that 7 to 8 people want to buy that car, but supply is very less because car is one and buyers are more. The supply of car is less, so now that the car will be auctioned and the car will be sold at highest bid. Now let's say there are 10 cars up for auction which is exactly the same and the price is also the same, and you want to buy one of those cars. When you go to the auction to buy that car, it turns out that you are the only one. So here the supply is very high because the car is 10 and demand is very low and the buyer is only one who has to buy only one car. You will buy that car from the one who is ready to give the car at a low price, and when the supply is high and the demand is low, the price fall. When there are more people selling shares and there are few buyers of that share, then those who sell shares are ready to send their shares even at a low price. Similarly, when there are fewer people selling shares and there are more stock buyers, then the buyer will ready to buy the shares at high price also. Number 5, leader or laggard. Focus on leader and avoid laggards. Laggards means sympathetic stocks, and such stocks should be avoided. The company that you have selected should be among the top 3 companies in that sector. Avoid stocks whose relative price strength is below 80. Number 6, institutional sponsorship. Select such stocks in which 3 to 10 institutional investors have invested heavily. When institutional investors invest in small cap companies, so the price value increases, and after some time many retail investors also start investing in it, thereby increasing the valuation of the company. Number 7, market direction. Follow market trends. For an example, COVID was encountered last year. Crisis was seen in the market, but IT company, food industry, pharma company and power company have given good returns because IT services have become the need of our day-to-day life. Food is very important for all of us that we cannot survive without it. People were getting sick. The need for medicines was also increasing. It has become very difficult to survive without electricity. That's why this company can never go to loss if you follow the above strategies. Hopefully you have learned something from this video. So please don't forget to subscribe to our channel to watch even more interesting videos, and you must visit our channel once, because the kind of video you want to watch, you will find that type of video on our channel. And thank you for giving your valuable time.